What if I told you that millions of Americans are right now trapped in their own homes? Not by debt, not by foreclosure, but by something that on paper looks like the best financial deal of their entire lives. They have a 2.5% mortgage, the lowest interest rate in modern history, the kind of loan your grandparents would have wept over, and it is quietly ruining their lives. Sounds insane, right? How can the best deal you ever signed become the cage you can't escape? Stick with me, because by the end of this video, you're going to understand the single most twisted financial trap of our generation. And if you bought a house before 2022, you might already be living inside it without even knowing. Let me paint the picture. Back in 2020 and 2021, the world was upside down. The pandemic hit, the economy froze, and to keep everything from collapsing, the Federal Reserve slashed interest rates to basically zero, and mortgage rates followed them straight down into the basement. Suddenly, people were getting 30-year fixed mortgages at 2.5%, 2,075%, 3%. Numbers that historically just don't happen. For most of the last 50 years, mortgage rates bounced between 6 and 18%. So when rates dropped this low, everybody and their cousin either bought a house or refinanced the one they had. It was a once-in-a-lifetime window. And here's the part that matters. It really was an incredible deal. I'm not going to sit here and pretend it wasn't. But here's what almost nobody saw coming. That dream rate came with invisible chains attached. The financial world has a name for this now. They call it the golden handcuffs. And I want you to really sit with those two words. Golden, because the deal is genuinely amazing. Handcuffs, because it has locked people in place and thrown away the key. Now, you might be thinking, okay, but how is a low payment a bad thing? I'd love a 2.5% mortgage. And that's exactly the trap. Because the problem was never the rate. The problem is everything that happened after. So let's fast forward to today. Mortgage rates didn't stay low. Inflation came roaring back. The Fed jacked rates back up. And now, new mortgages are sitting around 6%. Think about what that actually means for a second. If you have a 2.5% mortgage and you want to move, sell your house, and buy a new one, you don't get to keep your old rate. It's gone. You have to take whatever the market is offering today. So you'd be trading a 2.5% loan for a 6% loan on the exact same amount of money. And here's where it gets brutal. Let me give you real numbers, because this is where it hits home. Say you owe $400,000 on your house. At 2.5%, your monthly payment for principal and interest is roughly $1,580. Now, you go to buy a similar house and borrow that same $400,000 at 6%. Your new payment? About $2,400 a month. That is over $800 more every single month. For the same house, same size, same neighborhood. You didn't upgrade anything, you just moved. Over the life of that loan, you're talking hundreds of thousands of dollars in extra interest. And suddenly, you understand why people are staring at their front door like it's a prison gate. But here's what most people don't realize. This isn't some tiny niche problem affecting a handful of people. This is enormous. According to recent data, more than half of all outstanding U.S. mortgages have rates at or below 4%, and roughly 1 in 5 homeowners is sitting on a rate below 3%. We're talking tens of millions of households. An entire generation of homeowners who all locked in cheap money at the same moment and are now all stuck at the same moment. And when that many people freeze in place at once, something strange starts happening to the entire economy. Hold that thought, because it's about to get bigger than your house. Let's talk about what these golden handcuffs actually feel like in real life. Because the numbers are one thing, but the human cost is another. Imagine you bought a starter home in 2021. 2 bedrooms, perfect for you and your partner. Then life happens. You have a kid. Then another. Now there are 4 of you crammed into a house built for 2. Every normal instinct says move, get more space, upgrade. But you run the math and realize that moving up the property ladder would nearly double your monthly payment. So you don't move. You stay. You convert the dining room into a bedroom. You put the treadmill in the garage. You feel stuck, but you can't even complain, because on paper, you have an amazing rate. That's the psychological torture of it. You feel trapped, but everyone tells you you're lucky. Or flip it around. Maybe you need to move for a job, a genuine career opportunity, more money, a promotion, in another city. In a normal world, you sell, you buy, you go. But now, taking that job might mean your housing costs explode. So people are literally turning down better careers to protect a mortgage rate. Let that sink in. We have reached a point where an interest rate is making people's biggest life decisions for them. Marriage, kids, careers, divorce, retirement, all of it now runs through this one filter. But what about my rate? And here's the twist nobody likes to admit. Even when life forces the issue, people contort themselves into knots to avoid letting that rate go. They rent out the old house instead of selling, becoming accidental landlords overnight with zero experience. They take out brutal home equity loans at high rates instead of moving. They stay in unhappy situations far longer than they should. All to protect a number. The handcuffs aren't just financial anymore. They're emotional. They've gotten into people's heads. And this is the part that fascinates me, because it reveals something deep about how our brains handle money. You see, humans are terrible at thinking about money in relative terms. We anchor. Once you've had a 5% rate, every other rate feels like a robbery, even when moving, might genuinely make your life better. Behavioral economists call this loss aversion. The pain of giving up that low rate feels roughly twice as intense as the joy of any benefit you'd get from moving. So even when the math says go, you can afford it, your life will improve, the emotional brain screams absolutely not. You'd be a fool to give that up. And so people sit, frozen, guarding a number like dragons, guarding gold. But here's the question that should be keeping you up at night. What happens to a country when nobody will sell their house? This is where the golden handcuffs stop being a personal problem and become everybody's problem, even if you rent, even if you don't own a single piece of property. Because when tens of millions of homeowners refuse to sell, the supply of homes for sale collapses. Think about it. Normally, the housing market works like a giant game of musical chairs. People sell starter homes to move up, freeing up those starter homes for first-time buyers, who free up apartments for renters, and the whole chain keeps moving. But the golden handcuffs froze the music. Nobody's getting up from their chair. And when nobody sells, there's almost nothing to buy. And what happens to prices when there are tons of buyers but almost no homes for sale? They go up. Way up. This is a huge part of why housing has felt so insanely unaffordable. It's not just high rates pricing people out. It's that the lock-in effect strangled the supply of available homes at the exact same time. So now first-time buyers are getting hit with a double punch, the highest rates in decades, and the lowest inventory, with prices that won't come down because nobody can afford to sell into them. An entire generation is locked out of home ownership, partly because the previous generation got locked in. It's a perfect, vicious cycle, but it gets even more interesting, because here's a question almost nobody asks. If this is so bad, why doesn't it just fix itself? Why don't rates come back down and free everybody? And this is the real gut punch, because for a lot of these homeowners, rates may never come back to where they were. That 2.5% wasn't normal. It was a historic anomaly, the product of a global emergency and emergency money printing. Forecasters right now expect rates to stay in the 6% range for the foreseeable future. So the people waiting around for their golden moment to return, waiting for rates to drop back to 3% so they can finally move, many of them are waiting for a train that is never coming. They're not in a temporary holding pattern. For some, this could be the permanent reality of their housing situation, and waiting comes with its own hidden cost. Here's what I mean. Every year you stay frozen, your life keeps moving. The family keeps growing. The job keeps calling. Your knees keep aging in that 2-story house with the bedroom upstairs. The low rate saves you money, yes, but what is it costing you in the life you're not living? This is the cost nobody puts on a spreadsheet. The opportunity cost of a frozen life. And I think that's the cruelest part of the golden handcuffs. They make you feel responsible and smart for staying put, while quietly charging you in a currency that doesn't show up on any bank statement, time, flexibility, and possibility. So what do you actually do about it? Because I don't want to just scare you and leave. If you're one of the people holding one of these low rates, here's the reframe that changes everything. Stop thinking of your rate as something you have to protect at all costs, and start thinking of it as one factor among many. Run the real math. Sometimes moving genuinely isn't worth it, and staying put is the right call, and now you can feel great about it instead of trapped. But sometimes, the better job, the right house, the move that improves your actual life is worth the higher payment, and the only thing stopping you is an emotional attachment to a number. Money is a tool to build the life you want. The moment the tool starts running your life, you've got it backwards. And if you're on the other side, if you're a renter or a hopeful first-time buyer feeling locked out and furious, here's your edge. Understand that this freeze can't last forever. Life eventually forces people's hands. Divorces happen, jobs relocate, people age and downsize, families grow, and slowly, homeowners do start letting go of those rates because life is bigger than a mortgage. The lock-in is already starting to loosen at the edges. The patient, prepared buyer, the one who keeps their credit strong, saves aggressively, and is ready to move when the window cracks open, is going to be in an incredibly powerful position when this thaw accelerates. While everyone else panics, you'll be ready. So let's bring this all the way home. The 2.5% mortgage was sold to us as the deal of a lifetime, and in pure dollar terms it was. But the real lesson here isn't about interest rates at all. It's about how the best-looking financial decisions can quietly become traps when the world shifts around them. It's about how a number on a piece of paper can end up making your biggest life choices for you, if you let it. The golden handcuffs are real. Millions are wearing them right now, and the people who break free aren't the ones who get lucky with rates. They're the ones who remember that a house is supposed to be where you live your life, not the thing that keeps you from living it. The rate was never the prize, the life was. If this changed how you see your own situation, the next thing you need to understand is how the same trap is forming in a completely different market right now. And I broke that whole thing down in the video on your screen. Go watch it, because once you see this pattern, you'll start spotting it everywhere. I'll see you in there. And subscribe to Gothic Finance for more videos.